Hi, everyone. Thank you so much for joining us today. We're going to have the slides up here in a second, but this is new Global Playbook, International Tax Game Changers. Here we're going to discuss a lot of the changes in the One Big Beautiful Bill, as well as some other trade policy changes. This is the fifth in our six-part series of tax horizons planning ahead after the reconciliation bill. I'm Casey Pittman. I'm the Managing Director of Tax Policy here at Cherry Bekaert. And again, I'm excited for you guys to be here with us. This is one of the most complex and nuanced areas of tax compliance and consulting. And so I'm delighted to introduce Brian Dill and Walter White. They are partners and managing directors, respectively, in our international tax group, the group that Brian leads. And they have just been such an invaluable resource to all of our clients and professionals in the wake of what is a very tumultuous time in terms of changes in the international tax regime. So really quickly, I want to talk a little bit sort of broader policy. I'll talk a little bit about the bill before I kick it over to our experts, and you can hear from them on the international tax provisions. But just a quick rundown of what we're going to cover today on the screen here. Okay, so tax policy, gosh, tax policy is having quite the year. The Republicans passed their One Big Beautiful Bill on July 4th. It was signed into law after, it may seem like a couple months of work, but it was really a years-long run-up. The impetus for this bill was that the Tax Cuts and Jobs Act, many of those provisions were expiring at the end of this calendar year, to include the international tax regime. There were some automatic changes that were going to happen if they weren't addressed, as well as almost all of the individual provisions and those for flow-through entities. And this was a huge effort. It was a massive bill, $4.5 trillion of net tax cuts, more tax cuts than that, but those were the net tax cuts. It wasn't, the cost of the bill was a little bit less, about $1 trillion less, because they found pay-fors in other areas, primarily, Medicaid and SNAP benefits. But again, just a substantial effort, and it provides a little bit of certainty in what are really uncertain times for multinational entities on the tax regime for the United States. Again, international tax regime. Ultimately, Tax Cuts and Jobs Act fundamentally changed the international tax regime for U.S. multinational companies. And these provisions that they'll go into, again, we're going to face these automatic changes. We've seen changes here. They're not just in like rates, but also in definitions and the way a lot of these deductions work. We also have a lot of provisions that are not necessarily international tax: research and experimental expenditures, bonus depreciation, interest expense. These are all taxpayer favorable changes that were included in the bill, but they can often have unintended consequences, right? When you go to complete your GILTI calculation or other international tax regimes. So it's really, really important. And I think you're going to see this through the presentation, modeling and being prepared for the outcome of decisions you make. Again, some decisions that are meant to be taxpayer favorable can have these unintended consequences in the larger context of your global tax rate. So pay attention to those. I know they're gonna provide some really great information today. And then just a couple other things that we're watching here, to include trade policy. One of the biggest things that happened in this bill for international taxes, what didn't happen, it's that the Section 899 retaliatory taxes, which were the media was referring to as revenge tax, were not included. And that was because at the very last minute, Treasury Secretary was able to secure a deal with G7 countries, essentially to exempt the United States from a lot of Pillar Two, to implement a side-by-side system saying, hey, we are the United States entities are face a robust tax regime, and we certainly don't need to face any UTPRs or other what the U.S. deems as unfair taxes. So this provision got dropped. If it had been left in, it would have increased taxes on both entities and individuals from countries where the United States has deemed the country to have unfair tax practices, which is essentially compliance with Pillar Two. So that is in the works, right? The framework was released, a sort of broad overall agreement, but the details have yet to be fleshed out, to be released, and then again agreed to in the G7, the G20, and then the 140 countries who have agreed to the OECD. OECD actually has a meeting that's going on this afternoon, which in Europe, sorry, European countries have a meeting this afternoon to discuss OECD procedures. And so we're going to get more information here in the coming days. But if this is not something that gets worked out here in the short term, we may see a resurgence of this Section 899 tax. And that's something that Treasury came out yesterday and said that they would support Republicans in if they wanted to bring it back. But that, and then we've also got ever shifting trade policy, much of which is at the sole discretion of the executive branch of the president. These IEPA tariffs, in addition to Section 232 tariffs, they all have different implications for businesses who are trying to get a handle on their trade practices and pricing strategies. So I know we're going to hear a little bit more about that today, and that is an area that continues to evolve, honestly, weekly at this point, sometimes daily, but often weekly. So with that, I would just love to turn it over to Brian to take you into some of the details here. Oh, sorry. Really quick, before I turn it over, a polling question. Which changes will have the largest impact on your bottom line? Changes to international tax regime included in the bill, beat FDII, GILTI, which are now also have new names. I'm sure we'll go over that here shortly. And then recent changes to trade policy, retaliatory tariffs, Section 232, trade deals, both or neither. So if you could answer our first polling question, that'd be great. And with that, I will turn it over to Brian's capable hands.
Thanks, Casey. Really appreciate it. Well, let's get started. I think, Casey, you had a valuable point. And as we go through this, and I'm going to spend a little bit of time and actually walk through a numbers example today to just show at a very, very easy level how simple changes in the law can have changes to your tax results that you don't think would occur. And we're going to kind of go through that. And so, if I can say anything, because there are so many changes that have occurred both on the domestic side and the international side, that what is occurring, and we're seeing this as people are running their models, that they're getting results they were not anticipating. They thought, I'm going to take the additional depreciation this year, and it's affecting my interest expense deduction, or it's going to affect my NCTI that I'll talk about, or I'm not going to be able to get the new FDII deduction, or I can't utilize all my credits here in the United States. So if you're not going to model, if you think you can just off of a napkin think this is how the numbers are going to work without actually modeling it, we're seeing a very different result, and people need to really think about how they're going to model these numbers, especially on the international tax side. So let's get started. GILTI becomes NCTI. And what that is, global intangible low tax income is going to become net CFC tested income. And really what this is, and we'll get into this on the BEPS and Pillar Two, it's the global minimum tax. Originally, global intangible low taxed income was to fight companies that were operating offshore and earning intangible income and not paying a sufficient level of tax in the foreign jurisdiction. Therefore, GILTI was imposed in TCJA, or Trump 1.0. And what happened was that you would have to then recognize that foreign income in the controlled foreign corporation at the US level and pay tax immediately on that. And that's now become net CFC tested income. So what has happened, we'll kind of go through these numbers, but at a very high level, what we anticipate is that C corporations that had manufacturing operations may have been benefiting more, and they may realize an increase in their US tax burden versus tech companies or professional services companies that were operating overseas and were suffering the most under the GILTI regime, they may actually receive some benefits because of some very details in the way you calculate your foreign tax credits, and we'll get into that. So at a very high level, deduction percentage is reduced from 50 to 40%. You know, GILTI used to get a 50%. Starting in 2026, not 2025, it's going to be reduced to 40%. And then that would effectively increase the rate to 12.6%. The really big things are in the QBAI deduction, your deemed return on your tangible assets overseas. That's gone away. So for asset heavy companies operating overseas, that benefit has gone away. The foreign tax credit limitation, however, back in the US goes from 80 to 90. And this is really the big one that I think are going to surprise people, is that the expense deductions that had to be directly apportioned against your GILTI income will no longer be apportioned. And so for companies that have a lot of R&E, interest expense, they may see a big benefit in the NCTI because they can utilize more credit. And like I said, the changes are effective beginning in 2026. One thing I will say is because it does become effective in 2026, there's a lot of planning opportunities, accounting methods. How are you going? Maybe it's better to realize more foreign income this year under the GILTI regime. Maybe it's better to defer under your accounting methods and recognize more income under NCTI. Can have a material impact on your overall tax position. If you're going to accelerate your domestic deductions this year, or you're planning on starting to see NOLs, how's that going to impact your deduction percentage? Remember, GILTI and NCTI, the deduction comes after application of your net operating losses. So if you take an NOL, you don't get the deduction. So that can have a negative impact on your ability to monetize credits and take that deduction. So let's get started. Like, give me 5 minutes. I know this is hard, but give me 5 minutes to kind of go through the numbers. You don't have to focus overly detailed on these numbers. Just see broad brush strokes about how one company under one regime benefited, and now we're going to flip to another company that is going to benefit under the new regime. And I will explain kind of from a policy perspective why that is and what the administration is trying to achieve through that in Congress. So let's assume we have a manufacturing company and a technology company. Both have taxable income overseas in their foreign subsidiary. Taxable income meaning taxable income under US tax principles of $2 million. Manufacturer or foreign company A, foreign sub A, pays $150,000 of tax, and technology company pays $300,000 of tax. Like most technology companies or foreign services, they don't have any tangible assets. I mean, yes, they got some office equipment and, you know, they've got the coffee machine, but beyond that, they don't have a lot of tangible assets. So they don't have a lot of QBAI. They have zero essentially. But the manufacturer here has $10 million of factory assets. And I kept these numbers small, but you know, if you go to real life, you know, think about a $50 million factory, $100 million factory. Think about this taxable income being 20, 30, $40 million. And then when you see these results and how they flip, you'll see how big we're seeing the numbers flip under these regimes. So under QBAI, you get a 10% deemed return. So essentially what happened was you reduced your GILTI inclusion for the manufacturer by $1 million under GILTI. So the technology company had to recognize $2 million in the US. The manufacturer got $1 million reduction because they had assets. And so going to the next stage, if I can find my cursor. There, the GILTI inclusion, $1 million, $2 million. You grossed up. This is what is known as 78 gross up. You gross up for your foreign taxes. So in your US tax return, your manufacturer is showing $1,075,000. Your technology company is showing $2.3 million. The deduction then was 50%. Let's assume the manufacturer was O-line manufacturing. They don't have any debt. Let's assume the technology company has large debt and interest expense and R&E. They have to apportion $1 million against it. So what that effectively does, all of those maturations really, is it reduces their foreign tax credit limit. So the manufacturer gets a $112,000 credit limitation, and the technology company only gets $31,000. They both made $2 million overseas, but their foreign tax credit limit is vastly different. And the foreign tax credit, you get 80% for the manufacturer, $60,000 credit. Technology company just gets $31,000, even though the technology company paid more tax. Flash forward over here really quickly. If you'll take a look down at the US GILTI tax expense line, the manufacturer only paid $52,000. The technology company paid $210,000 on their income. So under the GILTI regime, what was occurring were manufacturers were paying on average, if they didn't have a lot of debt, if they had a lot of tangible assets overseas, they were paying much less US tax than technology companies or asset light companies, as I call them. So what was happening is exactly what the administration wanted under TCJA, i.e., GILTI, low taxed intangible income. So they were saying, look, we're not allowing these technology companies to have their intangible income overseas and not pay sufficient tax. They didn't touch the manufacturers. Well, you have heard from the administration time and time again, we want to bring manufacturing back to the US. We want to bring manufacturing back to the US. So instead of GILTI, we now have NCTI. Let's assume the same numbers here. I don't know what happened here. I think it went the wrong way. We have, taxable income of $2 million on this foreign income tax and 300,000. So I don't know why we did this, but the US GILTI tax expense flips. So if we'll back up one here, you'll see the manufacturer had $52,000 of tax, technology 210. Under the NCTI regime, should be NCTI, the manufacturer had 136, the technology company goes down to 19.8. And we'll go through that in just a second really quickly. But what's happening here is now manufacturers or asset heavy businesses that don't have a lot of debt here in the United States are not benefiting as much as technology companies under these new regimes. And until you run the numbers, it's impossible to know, but it just shows that what is seen like a benign change, right? The rates didn't change that much. The deduction percentage didn't change that much. But in reality, once you get down to the numbers and you work through the model, the numbers can have big differences for various companies. Now let's flash forward to FDII becomes FDDEI. So what I just talked about with regard to bringing jobs back to the United States and punishing manufacturers or asset-heavy businesses overseas under the GILTI regime, under the new NCTI. Now let's look at this regime. We're not going to go through a number example here, but if you think about, okay, we want to bring jobs back to the United States, but when we bring jobs back to the United States in manufacturing, who are we going to encourage? We're now going to encourage more exports. And so the regime change here and the numbers are really pushing to enhance the export subsidy benefit. So they did reduce the deduction from 37.5%, but only to 33 and 34%. So it increases the rate to 14% beginning in 2026. But once you work through the numbers, just like GILTI, there's no QBAI anymore and 10% deem return, which is actually a good thing in the FDII calculation because it enhances your benefit, right? It's otherwise US income that would be subject to your corporate rate at 21%. It's now gets the deduction and is eligible at only 14%. The other thing to keep in mind, just like in the GILTI regime about interest expense apportionment, R&E apportionment, that will no longer be apportioned against your foreign derived deduction eligible income. So we anticipate actually, even though the effective rate went up on your FDII or FDDEI calculation, even though it went up, once you take into account these other changes, we really anticipate more C corporations will be taking advantage of this because we think the benefits may be actually increasing for lots of companies, and we encourage people to model that. Remember, the deductions under the NCTI regime are only for C corps. And remember, FDDEI, that's a tongue twister, is only available for C corporations. So if you are thinking that you have an S corp or a flow through, the FDII regime and the FDDEI regime is not available to you. So as you go through the analysis of whether you want to be a C corp or a flow through, these are things people should take into account. All right. Polling question. How prepared is your organization for potential changes to the GILTI and FDII regimes? I know public companies, they're getting ready and modeling it because they've got to be able to prep this and do this for the end of the year and for Q1. So they are going at it. But I would suspect most other companies haven't looked below the very highlights at this point in time. But I am very curious to know what you all are seeing out there. All right, we will push on. All right, and Casey mentioned this, the US retaliatory tax and BEPS and Pillar Two and the G7. I just wanted to kind of give a little bit of insight here about what is going on and why you should still pay attention to BEPS and the retaliatory tax because not everything, the dust has not settled. As Casey said, Section 899 did not make it in to the final bill because of a G7 agreement, but it was a framework agreement and it was not actually put in place as of when the legislation came out. So we will get started on retaliatory tax. So what was 899 and what were they trying to do? I think it's important to just understand because it's going to be understanding for you that are in international operations that you still are going to have to comply with the foreign minimum tax regimes that 899 was targeting. Those haven't gone away, and we'll get into why in a minute and why you're still going to have to comply, even though there was this great agreement reached. So 899 was really for US companies or operations of foreign businesses that were making payments to foreign companies that had what we would call discriminatory tax regimes or minimum tax regimes. And what it would do, let's say I am US Co. and I have borrowed from a UK bank, and I borrowed money from a UK bank. Currently, my interest rate is 0, but maybe, or I borrowed from a company in the UK. Currently, my interest rate is, 10%, but I pay 0% withholding taxes. Under this discriminatory regime, I would start to have to pay a withholding tax on those payments. So if I'm making $2 million of payments a year, I would all of a sudden have to pay $100,000 in additional payments to the bank or to the company overseas in the UK, because it would go from 0 to 5%, and it would continue to raise all the way up to 20%. Now, if I'm doing business with somebody like somebody out of the Middle East, a Saudi Arabian bank or something like that, which doesn't have a treaty with us, you would already have a 30% withholding tax, and it would go to 50% tax on those payments. So I know everybody said, well, those are going to be, they're going to punish the foreign countries, but it was also for US companies doing business here in the US, making payments to foreign companies overseas that were located in those jurisdictions, that were going to be punished also. And so there was a big lobbying effort across the board saying how it would be difficult, and why it would go that way. We'll go to the next one. So, what are these discriminatory foreign taxes that are being talked about by the Treasury Secretary, by the administration, that was agreed to in the G7 agreement? What were these taxes that we were talking about? And this comes under this great big regime that's been out there for quite a few years. And it's called, we call it Pillar Two, or you call it GLOBE. And that's really global anti-base erosion. And really what it was trying to do was stop global companies from parking easily migratable income into low tax jurisdictions. I mean, you've all read probably about the Apple case, the Google case, Starbucks. You read about Caterpillar not paying it, and they got hauled before Congress because they didn't pay it. This has been going on for decades. And so the US has tackled it in one way. We've now got NCTI, we had GILTI before, we had a different regime before that to tackle this. But largely the rest of the world had not had their CFC rules, or control foreign corporation rules, were not as strict. So they have gone down this path with OECD to subject companies to this minimum tax. And they were using these three types of taxes. And it's really the income inclusion rule, that you'd have to include income, under tax payments rule, UTPR is how it's known, and the qualified minimum top-up tax, QDMT is what they call it. And essentially what it's trying to do, and you've probably heard about this during the Biden administration, and you heard about it from Scott Bessent and Treasury Secretary, it's this minimum tax of 15%, and making sure that companies were paying 15%. So why? Why did the administration care about these minimum taxes and 15% when the US corporate rate is 21%? So why was this such a big deal to the administration, and why did they think it was unfair? Well, in a in a in a in a nutshell, the way you calculated your tax rate is not the statutory rate, but it's your effective tax rate. So for all of these tax incentives being offered, bonus depreciation, R&D credits, energy credits that were coming up, when you modeled that with those type of credits and that type of accelerated deduction systems, often US companies' effective rate on US was less than 15%. So there was a huge concern that the OECD and the EU were not recognizing that these incentives, and did not want to recognize how the US was handling minimum taxes. And essentially the EU was saying, you know, US, you get on board with the OECD and Pillar Two, or else we're going to make you pay these minimum taxes and have top-up taxes. And so this has been going, through several administrations, not just a Republican administration. This has been an ongoing fight for over a decade, and this has been coming to a head for quite some time. And what had happened was these minimum taxes were being adopted in several large jurisdictions, the UK being one of the larger ones, Canada going forward, they were starting to get to be in place and were becoming effective. And we were going to have US companies essentially be subject to these top-up taxes, or their income subject to top-up taxes in these foreign jurisdictions. And the US was like, time out. That's not it. So there was some widespread support, let's just say, about the retaliatory tax and not tolerating and letting the EU dictate US tax policy. And so what has occurred is that the G7, and it's the G7 countries, but it's important to recognize the EU sat at the table in these agreements also and came up with this framework decision. And so we have a framework decision, and where are we today? It's not law. Recent news has both G7 countries' legislatures and non-Gs resisting to make changes, though. We are seeing significant pushback. We're seeing progress, but we're seeing significant pushback. And we will wait and see how these things play out. What the US wants is what we call a side-by-side agreement, meaning that the US system of corporate AMT, I'm not talking about BEAT today, but the BEAT tax and our NCTI, our global minimum tax regime, is sufficient on a side-by-side basis with other jurisdictions' UTPR regimes. But we'll see how these play out. There is a lot of negotiations going on the side-by-side agreements. I think there's been substantial progress. I think there's going to be an agreement. I think, from my personal perspective, it's not Cherry Bekaert. I think we'll get somewhere. I don't think it'll be perfect. I think some companies will still suffer because of the way you calculate things. The way the current side-by-side agreement is written, the IIR and UTPR is included. The QDMT is not included. So that could hurt some particular companies from that perspective. I know that's a lot, but just to say it's not over. And if you are subject to minimum tax reporting in those countries, the G7 agreement does not absolve you. You still must file all the necessary paperwork and documents, and please get that done because that is still law in those particular jurisdictions. Okay. On a global basis, tariffs. I just wanted to touch on tariffs. I know it's not part of the international tax regime, but we're doing a lot of tariff and tariff planning because what happens on the income tax side sometimes has an indirect or even a direct effect on the tariff side. What does one do given the uncertainty in the courts? I think yesterday's decision by the Supreme Court to accept the cases and that it's going to be on an expedited procedural basis. We'll see if that goes as planned. I think a lot of people do think it's going to go as planned. We'll see how that goes. Briefs are supposed to be in by September 19th. If they have oral arguments here in the fall, we could have a decision as early as next spring, maybe. But in the meantime, tariffs are going to be applied, and that doesn't help you today. And other countries are imposing their own tariff, rules. So we are helping clients. We have aligned with a group of trade attorneys. And I'll talk a little bit about the IP side in a second, because we are seeing a lot of our clients and associates are calling us up and saying, well, my supplier said I've got to pay this new tariff charge. And we're finding out when we talk to the trade attorneys and we decide to look at these agreements, or we actually look at the harmonized codes, that suppliers are just passing on additional cost. There's no additional tariff. And so there's the beginning of some real contract disputes and costs being passed on. And so, with our groups, we have accounting advisory, we have ERP systems. I am working with those groups on the digital side to make sure our clients actually have access to the right data to see where their leakage is from a cost perspective, because there's a lot of change going on and people are passing through material cost that a lot of times they should not be passing through. So we are working with tariff attorneys on a lot of those things. Third point, are there tariff planning strategies? Absolutely. From first sale rule to free trade zones. We also have sophisticated IP planning techniques that we are working with trade attorneys, and we are working with IP attorneys. We're strategically aligned with them. A lot of companies we have noticed have been doing IP planning and not wanting to pay tariffs on the intellectual property value. There is some techniques, and we are working on those, but we're finding people are not protecting their IP. So we have aligned with an IP firm, Stern and Kessler, fourth largest IP firm here in the United States, because there's been several instances where damages were limited because of tax planning that didn't have the IP planning that went with it. So we work on a holistic basis to give you a complete picture there. Also, transfer pricing. A lot of people are surprised that the first thing Customs and Border Protection asks for on a related party supply is, well, give me your income tax transfer pricing report. Little surprised to learn, like, well, no, we report a different value for customs than we do for transfer pricing. That's a problem, folks, let me tell you. And we are seeing a lot of that people are surprised that Customs and Border Protection are asking for transfer pricing reports. It's one of the first things they ask for in a related party situation. We're finding companies don't have accounting and tax systems that are prepared for this. They don't go down to the SKU. They really don't know where their costs or their tariffs are. They don't know where their harmonized tariff codes look like. So I think a lot of clients and businesses out there are a little caught off guard that they don't have the details necessary to actually be in this new environment for trade planning. And I've already mentioned IP protection and planning, but that is a big deal. Every day, I'm probably taking 3 to 5 calls a day on tariffs and tariff planning and how it works from an income tax perspective. All right, let's see if this one works. Polling question number 3. Which global tax development is most relevant to your business planning? I'll give this a little more time. See, hopefully this one works out. OECD, G7 agreement, digital services taxes, which I have not mentioned today, BEPS initiatives, global minimum tax, UTPR, tariffs, or not sure. That's a hard one. That is a very hard one, because I think it really depends on what your business is in, what your stage in your life cycle looks like. It can be very different for very different businesses that we are seeing. And it's a very customized thing. All right, we will move on. All right, I have spoken. I have taken up a lot of time to talk about bad things. I was going to be the bearer of bad news. I'm going to turn this over to Walt White, and he is going to give us some good news finally that came out of Build Better Back. Walt, take it away.
Thank you, Brian. Good news, sort of, kind of, maybe not really. I don't know. It's very complex and very difficult to describe without using a chart. So if you could flip me forward to our first org chart. Give me one more. Thank you. Okay, so let me describe this fact situation, and this is the one that will apply all the way through. We've got a foreign corporation, and it's 80% owned by a foreign person and 20% owned by a US person. And let's say it has a 90% interest in a foreign company subsidiary, and the other 10% is held by a US company that is 100% owned by the foreign company. Okay, so we have this structure here, and the issue is whether or not the foreign company subsidiary on the lower right hand of the slide, whether or not that's a CFC. And so to refresh your recollection, the CFC is a foreign corporation that's 50% owned by 10% US shareholders. So we need to know if we've got 50% ownership by US shareholders. We look at direct ownership. There is a 10% direct ownership by the US company, indirect ownership of the US person at the top through the foreign company. But when we combine those two, we don't get to 50%. So the question is, do we apply the constructive ownership rules in Section 318? And that's where 958B4 comes in. It disables the constructive ownership rules for purposes of determining whether or not the foreign company is a CFC. So pre-Tax Cuts and Jobs Act of 2017, the foreign company subsidiary was not a CFC, and that's just the way it works. Congress was concerned because there's some games that can be played in this situation. There's not really enough time to get into all of them, but basically you could have a large foreign corporation that uses a US company as a blocker, basically. So we've got GILTI and subpart F income that's not going to be picked up by the US company because we don't have a CFC. We potentially have a dividend received deduction by the foreign company, maybe no withholding tax on the way out. There's some things that can be done, and Congress was concerned about that. And so to address that, what they did was they repealed Section 958B4. If you can give me the next slide. Yes. So they repealed 958B4, and this is where we are currently. So the way that works is everything exactly as I described before, except that the constructive ownership rules of Section 318 are applied in determining whether or not the foreign subsidiary is a CFC. And in this case, when we take 958B4 out of the analysis, then we have constructive ownership of the U.S. company of the foreign company subsidiary. So the U.S. company now has 10% direct ownership in the foreign company subsidiary, and they have constructive ownership of 90% through the downward attribution rules. And so that makes the foreign company subsidiary a controlled foreign corporation. And that actually takes care of the problem that Congress was worried about. The U.S. company now has subpart F income or GILTI income with respect to its 10% direct ownership in the foreign company subsidiary, because that foreign company subsidiary is now a CFC. But there are some unintended consequences that have caused a lot of confusion and a lot of pain. For example, the U.S. person that we see in the top left-hand corner, this repeal of 958B4 was not designed to affect that one way or the other. But now the U.S. person has inclusions, subpart F and GILTI inclusions with respect to its indirect interest in this CFC. It has reporting obligations. It's a U.S. shareholder that owns an interest in the CFC, and it's got to report that. And good luck getting information out of a minority-owned foreign company to be able to prepare that 5471. And there's a whole host of other problems associated with this. One is 338 acquisitions, for example. If the foreign company were acquired by a U.S. shareholder, the fact that it is owning CFCs changes the way the procedure works on that. The IRS Treasury published regulations on this. It addresses some of the problems. It doesn't address all of them. And quite frankly, it's a little bit of a mess until, and if you'll give me the next slide. There we are. The new act has partially solved the problem, or at least they've applied legislation with a little more direction. They've used a scalpel instead of a shotgun, I suppose. 958B4 is restored prospectively from January 1, 2026. And so that takes care of the US person here on the top left-hand corner. Actually, if that were all that were done, it would take care of the US company that is in the bottom left corner. But it was intended that this company pick up its share of Subpart F and GILTI income or net CFC tested income, as the case may be. So what happens is we've got two new terms that we have to deal with. One is a foreign controlled foreign corporation, and that's what the foreign company subsidiary becomes, and a foreign controlled U.S. shareholder. And the way the rules work under new Section 951 Cap B, if you have a foreign corp, in this case the foreign company subsidiary, and it has a foreign controlled U.S. shareholder, in this case the U.S. company, then 958B applies as if 958B4 had been disabled. So the long and short of that is the constructive rules apply, and the U.S. company is deemed to have a direct ownership interest in the foreign company subsidiary and a constructive ownership interest in the foreign company subsidiary. So the foreign company subsidiary becomes a foreign controlled foreign corporation, and the U.S. company picks up 10%. So not 100%, but 10% of its share of any Subpart F income or any GILTI or net CFC tested income, as the case may be in 2026. And that's about all I want to cover on this, but I do want to turn your attention to a case that's out there. Take a look at the Altria case. It was filed in federal district court in 2023, and this resulted in about $100 million of tax. Altria is in the position of the U.S. person in this chart, and there was never any intention that they pick this up, but they picked up just a whopping amount of tax liability as a result of this change. And now they're changing the rules so that this would not apply prospectively, but now Altria is still in the situation during kind of the gap where they picked up that huge liability. And so that's something that we may want to keep our eye on as we go forward. So back to you, Brian.
Thanks, Walt. Really appreciate it. Well, I wanted to share some good news too, Walt. The look-through rule becomes permanent. But diving into U.S. international tax rules, historically, we have had a temporary reprieve on this rule, but it was very difficult from a planning perspective. And the look-through rule really is only beneficial if it is structural, right? Because it applies to your structures, and we can't be moving our structures every day. And so there was really no certainty whether the look-through rule would continue. And so it's very good that they did change the rule or extend the rule to make it permanent. And what was the look-through rule, and why do us on the international tax side care about that? Kind of go through just basics of international tax here for 1 minute, and then I'll explain. So we talked about GILTI today, but there's also another piece of Subpart F, not just the normal GILTI or NCTI regime. There's also Subpart F income includes what we call foreign-based company income, or FBCI, and that there's a subheading of foreign-based company income, which includes foreign personal holding company income. And it's exactly what you would think. It's passive types of income: dividends, interest, royalties, rents, and even annuities. So really the way the service did this, and this is way back when, well, 1962, the Kennedy administration put this in place. Foreign personal holding company income, they did not want U.S. persons to hold foreign corporations and earn this passive holding company income overseas. They didn't want to park their stocks and bonds overseas and be earning all this passive investment income and not paying U.S. tax. And that's really what this was all about. Well, what happens here? Let's look at this. We have a U.S. company that has a controlled foreign corporation, and let's assume that's the management company for your European operations, and it is not trying to earn regular passive income, but it has an IP company that's developing new IP overseas in the EU, and it has an operating company. It's providing services. Well, without the look-through rule, the CFC OpCo is licensing the technology from the IP company. That's a license. And so the IP company would have licensing income. That would be subpart F, subject to US tax immediately at ordinary tax rates. The IP company would be making a dividend up to the holding company or the management company. Dividends, that was being captured. And the CFC OpCo, the management company, loaned the operating company money, operating cash, and there's interest accruals and there's interest income. That would have been subpart F income. So a normal operating situation for an offshore business operating in foreign countries, all of a sudden you had issues of, wait, my interest, my license, my dividends, all of a sudden that was becoming subpart F income. And that's why they came up with the look-through rule. And the look-through rule means you look through the income. Let's look at the OpCo. So the interest income earned by the management company or the holding company, you look through that interest income to what is the type of income earned by the CFC OpCo. And if the CFC OpCo is earning regular operating income or performing services out of the operating company, it's services income. So as long as that's not subpart F income or some type of passive income associated, you could look through the interest and look at the services income earned by the CFC OpCo and therefore not have to pick up subpart F income. And that's really what the benefits of the look-through rule are, and that's why it was designed. It's a great thing to have, and we're very, in the international tax community, very pleased to finally have some stability in what we thought was long time coming. I mean, even Treasury and the IRS had said that for a long time, that they thought it was the right thing to do. So there was agreement in the entire community. It just took a long time to get there. And I know we've all seen this one, Walt, a trap for the unwary. And we saw it quite a bit over the last few years. What was occurring was pre-Build Better Back. What was happening was that a US seller would sell their CFC, their foreign company, to a US buyer. Let's assume the US seller sold it to the US buyer on December 30th, 2024. And let's assume that this CFC for the 2024 year had $5 million of GILTI income. Well, there was a lot of surprises when we would review deals on the compliance side that nobody had considered, that the US shareholder at the end of the year is the one who gets the entire pickup. So all of a sudden, the US buyer has an additional $5 million of income pickup on its US return that it never thought it was going to pick up, because they would come to me and like, but we only owned it for a day, Walt. Why do I have to pay this? And that was a surprise to a lot of people that did not get the proper international tax advice during the acquisition and during the buy-sell. Well, fortunately, the OBBA has corrected that issue for 2026. I must reiterate, in 2025, guess what? It's the old rule still applies. So for acquisitions and sales in 2025, please get proper advice. And in 2026, though, it's a pro rata share, fortunately. Now, I will say, and this is for those of you that are doing U.S. international tax on a real basis, 956, if you have 956 pickups, that is not included in that rule. It's who has the 956 on the last day of the year that gets the 956 pickup. So 956 can still be a trap for the unwary, and the pro rata share rule may not give you the benefits that you're looking for. So just be careful there. We are coming up on time. And well, everybody, thank you so much for spending time with us today. I know it was very dense. I really wish I knew a way to do this, but this concludes our session. We have one more polling question. Do you want someone from Cherry Bekaert to reach out to you about the topics discussed today? And please know that this is a very complicated area. There's a lot of numbers that are driving the results, but we'd be happy to talk to you or walk that through. And we really thank you for joining us today. And if you have any questions, please reach out to us. And then in 2 weeks, we have our last webinar in this series, Capital to County, State and Local Tax in Focus. The webinar will be on September 24th on a Wednesday at 12 p.m. Eastern, just like this one. And of course, we always value your feedback and ask that you take part in the surveys and get back to us on that. And this concludes our session today, and thank you for your time.